Hi folks, welcome. We're on. It's another Tuesday evening and we're in pre-show mode once again. Great to see so many on already and some interesting questions already emerging in the chat. I think we'll get some more soon too. We'll just let this run for a moment or two to give people a chance to come on. There's a question from Marley there, which is quite interesting. We'll see whether we can get that up later on about metals and Perth mints and things. So that might be one to pick up. I saw there was a question earlier on about what are the leading signs for a crash later on, right? Are we going to go up? Are we going to go down? And George asked the question about should we be buying BBUS or Bitcoin yet, right? Very interesting questions there, particularly with Bitcoin going from below 20 to over 40 and then back again in just a few hours. All to do, of course, with Amazon announcing they're going to try and hire somebody to talk about blockchain, and there was a speculation that they might be going to take receipts by Bitcoin for goods, but they've denied that. So there you go. It's very interesting. A lot going on. As Cookie says, 4 weeks more. That's nothing. Yeah, because New South Wales looks like we're going for another 4 weeks, unfortunately, of lockdown, although construction will be back on Saturday. Whoopee. So the construction centre got their way, even if nobody else did. Interesting times, isn't it? Okay, well, I think that's probably enough on the pre-show. Let me just take that off. I'll then run the intro, and then in a moment I'll bring Damien in. So hang on. Well, good evening and welcome to this live stream event on the 27th of July 2021. Martin North from Digital Finance Analytics here. Great to have you on the show tonight. And I have Damien on standby. He'll be with me in just a second. Just before I do bring him in, let me just go through what I always highlight, that this is not financial advice. This is just a general discussion about the things that we're both observing at the moment. Also, please do play nice in the chat room. No racial slurs. We do moderate the stream. This is as of the 27th of July 21. And if you would like to get my attention, use @Walk the World to make sure that I see your question. It's just because there's so much going on in the chat. I do encourage people to share thoughts and opinions as we go through this evening. And that just helps me to see through those and to see the questions. I've also enabled Super Chat, which has two effects. One is that if you use Super Chat with a question, you can get to the top of the list, which is one way to do that. The other is if you'd like to make a contribution to help us run the shows here. We don't do this for profit. We do it because we are very passionate about this particular set of questions and issues we have at the moment. And anything that people feel they can support us with really helps just to make the wheels go around. And so with that introduction, let me just push this button and hopefully Damien will be there. Damien, are you there?
I am, Martin.
Right, so why am I not seeing you? Let me just prove that. There we go. Hi, yes. Hi. Good.
Yeah, nice to be here. It's yes, it's the shoes on the other foot for a change. We're coming out of lockdown yeah. It's usually you talking to me in lockdown.
Well, it is interesting. I mean, you know, what we don't quite know what's going on. We know South Australia's coming out of lockdown. We know that Victoria's coming out of lockdown. We know that New South Wales is going in for another round of it, at least a month. My own view is it's more likely to be probably into October before it all shakes out. So we haven't reached the peak yet. So it's not looking particularly good, I'm afraid.
It is looking like a long one for Sydney, and I think though, from an investment perspective, if we want to sort of look forward in terms of what to expect, I think really paying attention to what's happening in the UK is important at the moment. So they've sort of declared their Freedom Day, and that they're removing restrictions and trying to get back on with normal life, and so they've reached a vaccination rate that's one of the highest in the world, and so and I think even though cases have started to turn down, I think that's not the thing to watch. It's really the hospitalizations and the deaths, and it's been pretty good so far, and that's a pretty good sign for the future, I think. but one to keep an eye on, and the second one is the US is almost basically running a big experiment on its own population, in the way that they've got the same country with so many different states all having different vaccination rates, all having different things about lockdowns and not lockdowns, and whether they believe it or don't believe it. And so I think you basically a little controlled experiment you have for to sort of see where the future is. And to date, it is to me looking as if you get the vaccinations there, and you can start returning to normal life.
Absolutely, and I owe you an apology, Damien, because I've spelt your name wrong.
Yes,
I was doing it quick, and I got in the wrong order. I do apologise. Thank you for not taking offence.
No problems.
So, look, there's a lot we want to get through tonight, but I think the fundamental question is, right, the markets, of course, have reached something of a high. In the US, they were hitting highs again. The price to earnings ratios have actually come back because the results have been so strong. So on one hand, there's a hypothesis to say there's plenty more runway for the markets to continue to grow, particularly as the quantitative easing programs continue. On the other hand, there are also people saying, no, this is actually now real bubble territory, and it's going to actually come back at some point. Not quite sure when or how, but things are really stretched. And if you look below the surface, you can see some signs. And of course, the China, the tech stock sector in China in particular is wobbling. That's having an impact in some sectors of the US. The quantitative easing programs are still there, but people are talking about tapering or not tapering in the Fed, etc. I think fears of inflation have pretty dissipated a bit. The bond markets have moved. A lot of moving parts. So give us your scenarios, Damien. How do you think about this when you're trying to make strategic investments decisions? I mean, it seems to me this is probably as chaotic as it's ever going to be.
Yeah, there are a lot of moving parts at the moment. And so I think there's I'll start with the key thing that I've spoken about every time, and I'll keep speaking about it every time, is we're not in a normal market. We are in a situation where central banks are supporting markets, and governments are bailing out people, companies and sectors that perhaps should be going broke, and they're throwing as much money as they think is reasonable back into the markets. So into the populations, and the populations are saving a lot of that money, and a lot of that money is ending up in markets. So that's our overall key thing to keep an eye on is, will there be policy error? And that's the part where I'll tell you where I'm expecting things to go, and where there's some risks to that. But the key thing we have to keep watching at each stage is that policy error. If governments and central banks think that we're out of this, and they wind everything back, and we're not out of it, that's the real danger. They're basically getting in front of themselves. So it's a bit of a nuanced view at the moment, which is, but I'll try and talk through the summary of it, and then maybe we can dig deeper into some of the individual parts. I think the last time I was on here, and probably the time before that as well, I was on talking about saying, and I think we're both agreeing that we thought the inflation was transitory. And in particular, one of the things which we were highlighting was that it's what we've been calling an inventory supercycle, in that you get this sudden rush of demand, people can't keep up, the orders all of a sudden shoot up, there's some problems with supply chains, so that they get dragged out, and the demand just gets higher and higher. And we saw that in the lumber prices, I think we spoke about last time, was one of the real sort of key measures of that, where they went sort of $300 or $400 a ton up to $1,700 a ton, and then collapsed back again. And that's one of those the signs that we're seeing that yes, this is an inventory cycle. So that's one part of it. The next part, and probably the key part, is what's happening in China, especially for Australia. So China runs an economy that is incredibly reliant on capital expenditure, both infrastructure but mainly building new apartments for people moving into cities. They're miles in front on that. They've got lots of spare stock, and so and what's happened is, as this inventory push has come through, industrial production in China has skyrocketed, and so China's used that opportunity of all of their industrial sector and the manufacturing sector running really hot. They've used that opportunity to wind back on all the lending and wind back on the infrastructure and wind back on the property side. And you can see that in the property sector in China has been absolutely decimated. The largest stock, it used to be the largest stock from an equity point of view. I think it's probably still the largest stock from a debt plus equity point of view because they've just got so much debt. Evergreen is looking like it's going to go broke. So its market pricing says it's going to go broke. I think they have a debt pile of at least 120, 130 billion that you can see. There's quite possibly other debt behind that, and their equity, which used to be bigger than their debt, has now shrunk to around about 10 billion in debt. So it's like it's 10% of the size of the debt. And that's just the debt we can see. Let alone we suspect there's probably more sort of quasi debt sort of behind that. So so the China situation slowing down. Then we go across to the US, and you see within the US what's happening over there is we have a bunch of stimulus checks were sent out earlier on in the year, and that sort of got thrown into the US economy. There's a whole bunch of infrastructure stimulus coming, but that hasn't started yet, and infrastructure as well doesn't get off that quickly. It takes a while to sort of ramp up. And so there's this real potential that they've got this growth hole going to turn up where China's rolling, the growth in industrials rolling off. They've already stamped out a lot of the excesses, or some of the excesses in the property sector. They probably will slam the accelerator back on in that sector once they're worried about it. But they do want to try and normalize their economy, and they know it's overbalanced, so they probably don't want to do that too quickly. They want to try and leave it as long as possible. So there is this real potential. You get this growth hole, and if at the same time you have central banks, withdrawing stimulus, tapering, and generally making a policy error, that could end up in a reasonably big market downturn. So that's the bad side. The flip side is they might come even sooner. And if we've had this later run of Delta, maybe we get another batch of stimulus, around the view of, hey, look, we're almost there, we're almost vaccinated. We've just got this last bit to get over. Maybe there's another wave of stimulus coming. There's also the reopening side of it. So, the US sort of, depending upon what happens in the UK, the US might well be reopening. And you might have central banks have been pretty steady on the whole, the inflation is transitory, and they might see that this growth, and they might decide to throw even more money at the situation. So, and that could really end up with equities in this almost perfect position where interest rates aren't going up, so you don't have to worry about that from the valuation perspective. Consumers are saving lots of money. There's not a lot of wage rises out there, but there is this sort of pent-up demand starting to hit. And corporates have generally got rid of a lot of staff during the downturn, and there has been some real productivity gains, and they won't need as much. So they can really earn a lot more. You could see, this those productivity gains and everything. We've already had a few earnings surprises. If you had another, 10, 15% earnings surprise, the median company in the market would actually be back to its long-term average, or its 10 and 20-year average in terms of the profitability. Not quite same as the total market, because we actually have some stocks like Amazon's and Microsoft's and Facebook's and everything like that are actually a little bit expensive, but are such a large, or a little bit more expensive than the average stock, and are such a large part of the market. But you could easily see some of those ones. They might have a 20 or 25% rise in earnings, and they would be back to their longer term averages. So you've got two scenarios there. One, disaster, and the market's off 20, 30%. Another one where markets just keep grinding higher, and we just keep seeing more of the same. I think the danger case is a little bit less likely than the just grind higher, but it is a real and genuine risk case that is not. It's not sort of a tail risk. There's a 1% chance this might happen. Keep an eye on it. This is probably, I don't know, somewhere between a 20 and 40% chance that you get there. A big enough that you need to be aware of it in your investing and taking care. The most likely path, I suspect, is probably that we do get a bit of a downturn. Markets start to panic a little bit about the whole growth part, and then the central banks and everyone rides to the rescue, and so maybe you get a 10%, 15% downturn, and then you get ridden to the rescue and off you go. But then again, maybe they come in earlier, and you don't see much of a downturn at all.
And that really is the dilemma, isn't it? Now, there's a bunch of things I want to unpack there, but just before I do that, let me just shout out to Smooth Operator. Smooth is going to run up his trivia flag again in a moment. So, folks, Smooth will be running a trivia quiz on the channel as we go.
His spelling needs a bit of work as well.
Yes, exactly right. Yes, we need
not just you, bud.
No, we need some spelling corrections there. So I'll leave him to run with it. No particular prize from my end tonight, but just for fun, really. So have a go, see what the answer is. He always comes up with a really interesting question. So you go ahead with that, Smooth, as we chat. What I wanted to also do was to pick up one of the other comments from just a second ago from Jeff, who basically, I think, framed it like this. The question is, how long will central banks keep going, right? And to turn it around, can central banks stop what they're doing, right? And there was a very interesting report that came out from the House of Lords, actually, literally just a couple of weeks ago, called Quantitative Easing, a Dangerous Addiction. And this report, which included a number of luminaries, including Mervyn King, who was the Bank of England governor back in 2008-9 when they did QE the first time, as well as some very other important financially competent people, basically concluded that in the UK, the quantitative easing program was not really anything about what they said it was about. It was doing two things. Firstly, it was to provide really cheap funding prices for the big debt the government had. And secondly, the quantitative easing program was something that essentially was, very close relationship between Treasury and the Bank of England, to the point where the Bank of England has lost its authority and independence. And they basically said the Bank of England has no ability to describe how it's going to get out of all this quantitative easing, right? And so the question is, can they stop?
No, I don't think they can. I think that's Japan's sort of led the way in so many ways down this path. I think that one of the key parts for me is it's the fiscal side, and this has been the delegation of authority has happened over the last 10 to probably more like 20 or 30 years, where we didn't used to have independent central banks. Central banks used to be part of the government, and they were very political, and that was how we ran the economy. And we've had this whole idea that we'll create this independent central bank, and it'll be all these benevolent and all-seeing technocrats who'll lift our interest rates up and down, and we won't have to worry about it. But I think what's happened is that governments have sort of successively tried to outsource the entire running of the economies to saying, well, the interest rates would run everything, and really given up on this whole idea of fiscal spending to actually help sort of push things along. So we've started to see elements of that coming up in the US. We've certainly seen a fair bit of it in terms of temporary support right around the world with the coronavirus. The question is, will we see more sustained and higher debt fiscal policy run specifically to get us out of this problem? Because I think the problem is if you sort of say, well, we're just going to run sort of balanced-ish budgets, maybe a little bit of deficit at the moment, and a little bit of a surplus if things go well and whatever it is, and let's hope for the central banks will get us out there, then we're stuck where we are, where we've been for the last 10, 15 years, and where Japan's been for the last 20, is that, no, we can't get out of quantitative easing. But if you do get a concerted push into fiscal, and I don't think we've seen real signs of that yet, then yeah, I think they're absolutely right.
And that's obviously a concern, because what it basically says is that we're going to see more and more of the economy effectively owned by the central bank. They're talking about owning 30% of government bonds by the end of the September cycle, right? And they're talking about 15% of state bonds in Australia, right? And Japan has got even a larger proportion of the total Japanese economy inside its umbrella. It's almost like it's eating itself from the inside out, right?
Yeah, a little bit. It doesn't. It doesn't really bother me. I guess that type of debt. I sort of look at that and say, well, it's a bit like when my wife owes me some money, or I owe my kids some money, or whatever it is. If it's all in the family, then it's not as if we're endangering. It's a shift from one pocket to another. Within a family group, it's sort of saying
does it matter?
Does it matter from an external party? It's basically saying, if I've all of a sudden got an extra, whatever, $10,000 of assets and my wife's now got a $10,000 debt, or vice versa, from an outside party, the net worth of the Klassen household hasn't changed. It's one person's assets, the other person's liability, and so so from that perspective, I guess to me the Japanese scenario is really just. It's a bit of accounting, shifting money from one pocket into the other pocket, and then saying, yes, the Japanese government's got all this debt, but actually the Japanese central bank has all these assets that from and if they cancelled them tomorrow, if they just said, all right, overnight we're cancelling all those assets, what would the effect be? I don't think the effect would be much. Maybe markets would be scared for a little bit, but I really don't think there'd be a lot of genuine effect. I think. For me, I tend to look at all these on a net basis to work out how concerned I am about the size of debt, government debt levels.
Well, let's talk about net. And there's one interesting slide I want to show you, which is this one, which is the term funding facility on one side of the equation. So that's the money that the Reserve Bank has given the banks, 187.7 billion, right? And on the other hand, how much money is going back from the banks to the central bank overnight in reverse repos at 328 billion. In other words, there's more money going back from the banks to the Reserve Bank than there is from the Reserve Bank to the banks, which sort of suggests to me they've run out of ideas in terms of actually creating momentum, because the idea was that term funding facility was to allow them to lend. Of course, it controlled the rate, so it's driven the interest rate down, and I actually think that TFF was more about rate control than anything else. But it is an interesting observation that we've actually got more money sitting in the central bank. And in the US, we've got a repo market that is actually up to nearly $1 trillion. That's a reverse repo. So they've got the same problem there, right? So all this money that's being created, right, isn't going into the real economy because the banks can't swallow it, right? And so what they do in Europe is they've put a penalty on the money that's going back to the central bank. And then, of course, the central banks supporting the banks in terms of their profitability to keep the banking system alive. So we've got this really weird situation. I find it very hard to make any sense of it.
Yeah, well, and it's interesting from the Australian perspective. And Martin and I, we were talking about this earlier, but I think it's an interesting conversation to sort of bring out to your listeners as well, or your viewers, is that the QE programs, in terms of yield curve control within Europe in particular, is really designed to make sure the banks don't go bust. You don't want the banks going under, because you want to make sure they maintain enough profitability that they actually do want to get out there and make money and be able to lend money to people. So you've got this whole idea that if you let your yield curve become too flat and negative interest rates, then you need to be supporting that sector. So European banks generally trade on price to earnings ratios of single digits, and so sort of whatever 9 times, 10 times, that type of just very very low things. You look to Europe and Canada, to the US and Canada where it's similar, but not as bad as that, and you sort of get PEs of sort of 10 to 12 times, and every now and again you get an expensive bank that's sort of 13 or 14 times, and then you come across the Australian market, and we've got, CBA almost trading on 20 times. And we've got these banks that are so much more expensive than the rest of the world. And a similar type of scenario, really, this flat yield curve and government, the RBA trying to hand out money to get interest rates at the right level so they can help keep the profitability of the banks. And so it sort of raises that question of, well, is there something so different about the Australian banks that is, genuinely different to the rest of the world? And as far as I can tell, I don't think there is. Maybe the difference is our regulators are more captured, and so our regulators are actually going to be trying to keep our banks more profitable than what they need to be, so that they push more of this money out. But as your chart shows, it doesn't really. The banks will get out as much money as people are willing to borrow, And Australia's got a record debt, so it's like saying, well, how much money do you want to push out? And household savings are really pushing up higher. And this is this whole idea of pushing on a string. And the idea is that you give $1,000 to Gina Reinhardt, or Australia's richest, and they're just going to throw it straight on the pile. They'll put it back into the bank. And you give $1,000 to the poorest people, and it's out and spent. They're going to spend it. They're going to spend $2,000, and so that's the idea that if you can't keep pushing on this string, and you can't keep trying to let monetary policy do the work of fiscal policy. We've reached pretty close to the end of that game. We can make things worse, but it's very hard to make things better using only monetary policy from here.
Yeah, absolutely. And that's really the point, isn't it? There is a limit, right? And I have asked a few people around both locally and internationally, are we reaching the bounds in terms of what quantitative easing can do? They can go on creating more liquidity, right? But is it actually going to move the dial, right? Have we got to the point where effectively there's too much in the system already? It's already inflated financial assets. It's not going to the real economy. Interestingly, of course, in New Zealand, and there's some interesting comparisons between New Zealand and Australia, right? In terms of New Zealand, is saying, well, they might actually be putting rates up quite soon, later, maybe this year, August, maybe, And they're basically saying, well, we've got to try and start to get house prices under control a bit now that, of course, in New Zealand, the central bank there has a responsibility to think about what its policies are relating specifically to housing, right? Whereas in Australia, nobody really cares about that. It's not the Reserve Bank's issue. It's not the APRA's issue. It's not anybody's issue, really. So I can say it just goes like that, right? So there are some really interesting... And of course, it's somebody else's fault, right? And they all say, well, it's state planning, it's all that sort of stuff, right? And then the other point is that the difference between New Zealand and Australia is also quite interesting insofar that New Zealand is turning up the capital requirements much more strongly than in Australia.
Yeah.
So the ratios, it's like New Zealand is saying, well, we think there's some risks in the system and we want to start addressing it, whereas in Australia, they're saying, no, nothing to see here, just to keep QEing.
Yeah, and the other big difference, though, as well to remember with New Zealand is they're not New Zealand banks. The banks over there are all Australian banks that's the New Zealand operation of the Australian banks. So I think from a financial stability point of view, New Zealand's worried about making sure that that the houses and everything, the rest of the economy is going to work the way you want it to work, and you're not getting these the signals that are you're ending up with outcomes, the unintended consequences. What I'm trying to get to. Whereas in Australia, we've got the two things to maintain: is we say, well, we need to keep these banks from going broke, because if the banks go broke, then nobody's going to get any money. Whereas in New Zealand, it's about saying, well, they're not going to. A New Zealand property price crash isn't going to bring down the entire. Well, we hope isn't going to bring down the entire Australian banking sector because that's so much bigger. And so for them, it's about saying, well, we need to make sure the economy is doing what it's meant to be doing, and the banking system's doing what it's meant to be doing. Whereas in Australia, it's saying, well, we've got that extra constraint that we need to make sure these banks don't go broke as well, because then that'll make things dramatically worse.
Absolutely. And it's interesting, of course, because the Australian banks are now obliged to hold assets in New Zealand, whereas previously they were able to sort of smudge it and blur it, and they can't do that now. So the New Zealand regulators said, no, you actually have to hold assets in New Zealand against the obligations that you have there.
Yes.
For that very reason, right? Because they were concerned. And in fact, they had an IMF report came out a couple of years ago looking at New Zealand, and they said, do you realise, New Zealand, how risk exposed you are to the Australian economy and banking system collapsing, right? And that's why they've actually done what they've done. So they've sort of ring-fenced the assets in New Zealand. They've increased the capital ratios to the point where Westpac at one stage threatened to withdraw its business from New Zealand because of the costs of the capital that was being asked to hold there. They haven't done it, but they were looking at it at one stage. So, interesting.
So they say they were looking at it.
Yes. Yeah, well, it was called, I think, Who Blinks First, right?
Yeah, but I guess it's that issue. Not to push too far down this line, but it's the issue of saying, well, if you've got regulators treating banks as if they're more like maybe they should be treated, rather than trying to bend over backwards to make sure the banks can get whatever they want, then maybe that's, maybe there's some sort of tension there that's New Zealand's trying to resolve, where Australia's sort of perhaps leaning too far on letting the banks get away with, and making sure the banks are as profitable as they could be.
Absolutely. And there's a bunch of really great questions. I hope we can get to all of them. I can't promise we will. But this is one from Evan, which I quite like. Are negative interest rates possible in the US? Can a reserve currency do that? Now, negative interest rates can mean the relationship between the rate at the central bank. In other words, if a bank puts money at the central bank, they get charged. That's what's happening in Euroland, isn't it? Or it can be interest rates at the retail end. Right. Yeah,
and there's a lot of difference between that, and there's also this difference between whether you got a negative interest rate in terms of I bought a bond that's going to pay me back less in time, which doesn't happen that often, versus I have a central bank which is supporting, say, the banking sector by effectively paying them to make loans, and so. I think it is possible for the US to see negative interest rates. I think they're probably the least likely, though, to do it. Maybe there's an element of it being the reserve currency, but I think the bigger element is that they seem to want to, or certainly the Biden administration wants to get out and spend real dollars and get it into the real economy, into the pockets of people directly, rather than via the banks. And hoping the banks will lend it out and everything will sort itself out. So, of all the countries in the world, I think they're the furthest down that path. There will be some political issues they'll face, absolutely, and it could end up that that if they do particularly badly in the midterms and Republicans get hold of both houses, then maybe that's all going to stop, and there might be people. On the Republican side, willing to have a recession in order to get a president more of their liking through to the system. So, there's certainly that possibility, but at the moment, I'd say I'd be more worried about other countries and probably even Australia with negative interest rates before getting to the US.
Yeah, and of course, Lowe has said several times now it's unlikely that negative interest rates are going to come here, although others are actually a little bit more coy about it, and they quote a couple of recent IMF and BIS reports that suggest that there is actually a place for negative interest rates in the system, right?
Yeah, absolutely. And I think, I can't remember the levels, but for years, the Aussie Central Bank spoke about, I think, maybe being... I feel like it was 1% or maybe 75 basis points was like as low as they'd ever go, and we've got 10 basis points now, and then it's changed to, oh no, we wouldn't go below 50 basis points, and so things change. So absolutely they'll talk about, and they don't want to do it. None of them want to have negative interest rates, but if you're looking at, say, at a federal government that wasn't out there spending money and the economy kept falling away and unemployment was employment was weaker than what it is now, then the central bank can either push into negative interest rates and start trying different things, or they can put their hands up and say, "Oh, sorry, didn't work, guys. Better luck next time." So whereas my view is that's not what they're going to do. They're going to try something. They're going to try anything.
Yeah.
And negative interest rates is just one of those factors that's there.
And look, the fact of the matter is the quantitative easing will continue in some form. Rates will be driven down lower rather than actually rising, in my view, particularly now with the lockdowns locally, which of course then says, well, that probably means there's more upside to house prices than you'd have thought a few months ago. And of course, NAB has actually reforecast up significant house prices over the next couple of years, which is quite interesting, seeing it in the middle of all that's going on. But that just increases the housing unaffordability question, and it increases the debt burden for individuals, which of course is a problem in terms of it flowing through.
House.
Go on.
Yeah, can I give house prices they're similar to stocks in a way, in that except they're even more driven by interest rates, and so if you can get in this scenario where the overall economy is a little bit weak, but inequality is still growing, and asset markets are doing well. So stock markets are doing well. So you'll have a chunk of people who can't afford to get in the housing market, but a lot of those people would never afford it anyway. And so, but you do have a bunch of people with more money who are maybe buying second houses or upgrading, and interest rates are really low because central banks are because the rest of the economy is weak, and we have a government that's probably not doing a lot, but they do want to try and keep the housing market going. So maybe they're handing out some more incentives. That you end up in this scenario where it's just this purgatory of low interest rates and not much growth, but the housing market could just keep grinding higher in that sscenario.
Absolutely.
And so it's not a desired outcome, I think, but it's certainly a extremely possible, and it's also quite a dangerous one to bet on though as well from an investment perspective, because you're in this part about saying I'm going to bet things are going to be bad, but not so bad that the housing market crashes, and not so good that interest rates go up and then the housing market will have to come off because people won't be able to afford it. So it's threading the needle.
Yeah, and that sweet spot is really quite narrow, isn't it? It doesn't give you very much wriggle room, either on the upside or the downside. So if we actually keep the status quo, then there is a window for prices to go higher. But if rates, as you say, start going up, prices will drop. Or if it goes the other way, prices will drop.
Yeah, and I think the rate rise part is, I don't know. I think we've got to see a lot more economic growth, and it's hard to see where that's going to come from at the moment. On the downside, I guess you support there comes back to governments again, with a view of if it does get really bad, then will government step in, and will they step in fast enough? And I think the history, if you had to sort of teleported us back to 2001 or 2002, I'd say, and gave us the same scenario, say, oh no, they wouldn't be fast enough. Government, and but the speed and reaction of central banks at every subsequent crisis, and governments as well, is getting faster and faster. They could. I wouldn't. Yeah, it's dangerous to bet against it. It's a real risk you need to do, but I wouldn't sort of go all in on a bet, assuming that the next time there's a downturn, it'll be disaster because central banks won't be fast enough to get in and save things.
And that takes us through beautifully to the next question from Ahmed, which is, are investors supposed to invest on tried and proven fundamentals, or are they supposed to invest on central banker intervention? And what does that say about capitalism? In other words, are we in a capitalist environment anymore, or are we in something else?
Yeah, well, it's not the capitalism we used to have. Let's put it that way. It's not this, and this whole idea of creative destruction and allowing companies to go broke. You would think we'll have to come back at some stage, but it's a capitalism where you can fail if you fail on your own. You can go bankrupt if you fail on if you stuff things up and you're on your own and that happens. But if you're in a reasonably big sector and the whole sector looks like it's going to fail, then there's bailouts and there's interventions and there's should you still invest in fundamentals? Yes, I still think there's a reason for investing on fundamentals, but I think those fundamentals need to reflect what's going to happen with central banks and with governments. So I think there's I'm certainly not of the view that profits don't matter anymore and whatever it is we're just going to go up. And I think the market movements over the past few months have been along those lines as well. So if I'd say that we had a real sort of junk rally last year, where a lot of the stocks that were going up were the stocks without any earnings and without a lot of they're all about the dream and low interest rates and yes, profits don't matter. Then we rolled into this year and we had this value rally where as people were worried about inflation and we had the traditional sort of cyclical stocks push up. As that then faded back towards scenario more like we saw last year with people expecting lower inflation, the junk growth really didn't perform that well, and has been trending down. Like the growth stocks that have been doing well are the ones that actually do have genuine profits and are making money. And so investing on fundamentals, there's going to be times where you're going to feel like you're an idiot. You're like, there's stocks that are losing money and just clearly not worth, what they're valued at are going to shoot up in value. But eventually they will come back to a more normal price. And I think, that if you keep investing on those fundamentals, you will see those returns in the long term, and you'll have a much lower risk performance as well, because there's, you pick a Tesla or some of these brand new stocks with no earnings, and all the SPACs that are out there, and they can double and triple and quadruple in a very short period of time, and then they can be back down similar levels. And it's more about running with the bulls and trying to keep it in front of the herd for that one, rather than investing for the long term. But
there are a lot of people, of course, who are basically trading volatility, right? They're looking for movements and then trading. And if you take crypto, right, as we mentioned earlier on, Bitcoin was below 20,000. It's now way up, right? Sorry, 30,000. Wherever it was, wherever it was, who knows where it is? 40,000, give or take. Yeah. But the point is, there are people who are able to play those movements, right? Either directly or indeed using derivatives against the Bitcoin, and there was a strong short sell because of the price going up, all those things, right? But that's a fundamentally different approach, isn't it, to investing, if I can quote unquote investing, to the way that you think about the market?
Yeah, absolutely. For me, it's very much about trying to come back with those core values, and so I basically look at all stocks as being a trade-off between the quality of the stock and the value of the stock. So you find a very high quality stock like a Microsoft or a Facebook or a Google that make consistent profits, very high margins, and relatively low volatility of their earnings. And you say, well, I can afford to pay extra for those stocks. I can pay more than average for those stocks because I'm getting such high quality earnings. And then you look at something like a cement manufacturer, which is it's a fine company, very cyclical earnings. They go from making lots of money to not very much money over the courses of a number of years and back again. And I look at those types of companies and say, well, I'm happy to buy them when they're cheap, very cheap. But if they get up to sort of being an average cost, then that's when I want to be selling them. So, very much the idea is. Sorry, I was distracted by that.
Sorry, that's just the trivia. So we're not asking you to engage in the trivia too. So there was a very interesting follow-up from Ray, which I'll just put up now, which is, what about insolvencies, right? Because there's something in the middle of all of this, right? Yeah. Which is actually bubbling along. And we know we've got more zombie companies, right? A lot of them are tapping debt, very low debt. We know that a lot of small businesses are also struggling at the moment, particularly with the lockdowns and things. And we know that the forward expectations of insolvencies are probably going to rise. And I was reading something, I think it was from the European Central Bank, that said, the problem we've got at the moment is that the capital allocation process is not working, because the capital is actually supporting all these zombie companies that should actually be allowed to fail, but they haven't been allowed to fail by central bank policy and by government policy. So again, how much is capitalism real at the moment versus actually keeping all the balls in the air and not allowing anything to fail?
Yeah, absolutely. And this is one of those, this is the key one for me, is that if insolvencies are allowed to sort of run a more natural course, then look out. Yeah, but I don't think they will be. I think the governments have shown, not just in this bailout, but basically every bailout since sort of 2000s, that they're willing to support companies that should perhaps go broke. I mean, Japan did it with a whole bunch of their companies, just bundled them all up, and they spent 20 years working their way out of the debt burdens. Some of them are actually looking reasonable now. But finally, yeah. But it was a long, slow process. China did the same thing last downturn. They bundled everything to a bad bank, and off they went. We had in Europe the extraordinary case of the Irish government sort of having to bail out the Irish banks so that they didn't bring down the German banking system. The idea is very much that that we will keep extending these insolvencies and keep preventing the insolvencies and just keep extending the current scenario. So key thing to keep an eye out for. I was of the view wrongly last year, sort of mid last year. I thought, look, the insolvencies will come. I thought, towards the end of the year, as it started to get to the stage where, or actually, I thought about a year after the start of the coronavirus, I thought it'd be about the time that governments start saying, well, okay, we can only support companies for so long. But then the vaccines hit and came out way in front of any expectations, and I think that provided enough cover for governments then to say, oh no, look, we're almost through this. No sense in letting all these companies go broke now if we've only got another few months. And I think that case will be extended for the next, I don't know, couple of years, I suppose, in terms of it being, look, the economy is still weak. We can't really allow these companies to go broke just yet. We'll have to try and support, make sure that doesn't all come down. And then once the economy is strong enough, then we'll let them all fall over. But it's a bit like your whole quantitative easing part, where once you've started down that path, it is very, very difficult to then say, or anyone with kids will know, you set the boundaries. You let a child stay up, their bedtime's 7:30, you let them stay up to 8 o'clock one night, and now 8 o'clock is now the night, the time they have to stay up to every night, There's and then you let them stay at 8:15. Now that's it. A precedent has been set. I'm allowed to. That's the time I'm allowed to go to bed, and that's the way I think capital markets will treat this. Is that no, we're not allowed to go broke. Under these scenarios. So.
Yeah, I can tell you, dogs exactly the same, right? If you don't set boundaries, they just keep pushing. It's just the way it goes. There was this comment from Xavier, which I think is actually very insightful. Capitalism does not allow for central banks to artificially suppress interest rates. That's the root of all these problems. They're not allowing for creative destruction, so asset bubbles are everywhere. I think that's exactly right.
And where we saw it at the start of the when the coronavirus really hit, is you saw that in in debt spreads. So the amount of extra interest you had to pay for private companies to lend to them rocketed, and that was where the US Fed, which is actually specifically not allowed to invest in those securities, came and said, well, yes, we are going to invest in those securities. They actually didn't have to do very much, because just the act of them saying they're going to brought those interest rates back down. But the spread you can get on debt for taking a risk is very, very low at the moment, and which is allowing companies to borrow at rates they haven't been they wouldn't have otherwise been allowed to, and it keeps those zombie companies alive.
But what is interesting, because I've done some consulting work for a few organisations, they still have massively high hurdle rates for projects, even though interest rates have come way down. Right, they're still looking for an internal rate of return of 12, 15, 18, 20%, which is interesting, right? Because that was the same sort of returns that you got when rates were at 7, 8, 9%. That's something not quite right there.
Yeah, well, I think. Maybe when it's your money you're investing, in terms of those types of projects, and people realise that the world's an uncertain place. If I think I can get a 12% return, and things don't go as well as what I expected, and I only get I get 10% less than that, I'm still positive. I haven't lost money on the deal. Whereas if you're investing on a 2% return and things are 10% worse than what you thought, then you're making a big loss. And so companies for projects, they like to have that a margin of safety in either direction.
Yeah, and I know the Reserve Bank's been banging on about that for some time as well. Let's go on to another conversation point. This is from Master Singleton from earlier on. What's your thoughts about investing in Taiwan semiconductor manufacturing companies, United Microelectronics Corporation, for example, due to the high demand for semiconductors and ICs? We know that there's a shortage at the moment. Is that an area that you're interested in? Have you looked at it? Have you thought about it?
Yeah. Look, I could spend a whole podcast on semiconductors. It's a fascinating area of the market. The US is changing what it's doing from a fundamental point of view from semiconductors. They had a big leadership, 20, 30 years ago. and they basically let other countries into with a view that other countries would do the low value part of it. So Taiwanese Semiconductor was one of them. There's some South Korean ones as well, but they had this idea that they'll just do the really basic stuff, and the US companies will keep doing all the really high-end, exciting stuff. And what they found over time is that the people that got good at doing the low-end stuff wanted to keep moving up, and then because they were getting good at doing the low-end stuff, they were getting some more of the top workers and scientists, and so that meant these companies kept on growing, and Taiwanese Semiconductor, TSMC in particular, doesn't do the design and everything like that. They take everyone else's designs, and they're just the best at building it, which is very different to, say, an Intel, which sort of designs its own and then builds its own and sort of works it from there. And so, but I do think there's been this step change where the US sort of allowed it to go elsewhere, and now they're trying to bring it back. And so there are political risks as well with Taiwanese Semiconductor, with Taiwanese companies in general, I think, and what's happening with China. There's political risks in terms of what China's doing as a response to this, and there's certainly going to be more money thrown at the US sector and US semiconductor companies by the US government. So yes, I have a bunch of different companies we've invested in, and there's this whole range. There's actually some of the companies we own that make the machines that make the machines, so to speak. And so there's this whole market about which are the ones you're buying that actually, and where the value is in the chain, and whether you're. I think there's certainly some of the really low value stuff which is the stuff that didn't get made. So recently, a lot of the shortages have been there, but there's all these new factories being built in the US in particular. Is actually got a number of really huge projects going on in terms of trying to bring more manufacturing back to the US. So I guess it's a long-winded way of saying it's a really interesting sector, but I don't think it's as simple as saying the tide's coming in, every single boat in that sector is going to get lifted. And it is a very cyclical sector as well. Is that what tends to happen is you get like tens of billions of dollars of capex get thrown at the sector, and then all of a sudden everyone's losing money or going broke or whatever, and then nobody invests much for 2 or 3 years, and then all of a sudden the sector's awash and making all this money, and then they go back through. It's a very cyclical sector, and right now there's a lot being spent on new projects. So I think you got a little bit of time in the sun, but that sector will have another big downturn, and that's probably the time you want to be buying some more and or looking for the real bargains within that sector.
And presumably Taiwan has also a geopolitical risk, right, vis-a-vis China, which is also worth factoring into the equation.
Absolutely, and they're actually building some of they're building factories in the US as well. So because they're trying that whole onshoring and everything like that. But Taiwanese Semiconductor is a very good company, and it's taken market share from a bunch of other ones. And so it's all about weighing up that now. You've got a high quality company, all these geopolitical risks, and how much do you want to spend on actually buying that particular company, and then what other companies in the sector are doing interesting things as well.
Okay, well, let's go on to another question. Very interesting one here from David Camp. Could you please comment on the so-called lazy portfolios, i.e. people who've set and forget their portfolios, right? And I guess there are quite a few people, directly or indirectly, who are in that boat. Yeah,
sure. If you've got a relatively well-diversified portfolio and it's very low cost, and you're going to set and forget, then I think you'll probably do fine. I think that's a reasonable investment strategy. I preferred, and I've actually got some products we're bringing out very shortly that have got something similar to that. I prefer to lean in to some of these cycles. I think that you can reduce your risk, and certainly what we've done so far with our portfolios has shown that we can reduce the risk by when markets are high, is that you're reducing your exposure to them, and when markets are looking more attractive, you're increasing your exposure. So you're not taking like massive wild bets, but you are sort of leaning into the cycle on both fronts. I think you can certainly get a much better risk return in terms of getting a return that's similar and a bit higher at a much lower risk. But if you've got a set and forget portfolio that's taken a few big bets and isn't particularly diversified and possibly it's got some high fees, then then I think you're asking for trouble. You could get very lucky and make a fortune out of it, but I think more than likely it'll go the other way, and you'll and you won't.
And an interesting question which comes up from time to time when I'm chatting with people informally is they don't really have a good feel of what they've invested in anyway, particularly if they're in a super environment where they've got this sort of rather opaque structure where it's sort of medium risk, high risk, low risk, whatever it is, but below that there's very little information about what precisely is in there, and not a lot of information actually about performance, other than of course they always claim performance is excellent.
Yeah, and a lot of more and more unlisted assets, and so we saw that during the financial crisis. Is all these guys with unlisted assets, and they said, oh well, they're worth roughly what they were before. A listed airport fell by 40%, and the unlisted guys were saying, no, we think our airport's about worth what it was last month. And so there's issues for, I guess, fairness when you're buying in and selling out of those ones, but. There's been submissions recently about trying to give more transparency to it, and the super funds are fighting back very hard about the transparency. I'm sort of sitting on the other side, so I get to throw stones. I'm in the glass house, but I do get to throw stones at this one because I show everyone who's invested with me every single stock that they invested in and what sectors exposures they have, and they get the full gamut. Everything that's there they can see, with the view that, well, I'm not going to be their only investment. I could be a central part of their investment, but they want to know that if I'm investing in say semiconductor stocks, which we are, then maybe they won't go out and buy them in their own name, or won't go out and buy as much of them. So there's been this push for transparency, and I saw I was just in the AFR the other day. They're talking about, I think it was Australian Super commenting that they're saying, well, we've got these unlisted assets and we're happy to tell you that they're worth somewhere between 100 million and 300 million, but we can't give you the exact details for privacy purposes and in case people trade against us or something. And you're like, just a minute. That's like a 3 times. I'm like telling you, Martin, your money's either worth 100K or it's worth 300K. I can't really tell you which one's which, Yeah. For most people, that's bloody important. A 3 times difference is pretty critical to the whole performance thing.
Well, and I know that the opaqueness in the system is horrible, right? One of the reasons why the tie-up with what happened was because you guys are so transparent, horribly transparent, actually.
Uncomfortably transparent, I like to call it.
Exactly. Yeah. Well, okay. Let's use that comfortably. But the point is, at least people know where things are and they can see what's going on. And if you compare that with the typical disclosure from some of the other funds, I mean, it's chalk and cheese. So that's worth something. Well,
there was a fund not that long ago had to be taken to court to work out what the fossil fuel exposure was in their portfolio. So we figure we'll just tell people this is what it is, and if you want to cut it out, if you don't want fossil fuels, then tell us, and we'll knock them out of your portfolio. So. Yeah.
And the other thing, just as we're on performance, because we could have a whole show about fund performance and how to measure it, right? Which we won't do, but we perhaps could do. But one of the things I do observe is that the general performance of the fund does not necessarily reflect the performance of the individual investor in the fund. See what I mean?
Right.
So you can basically say, well, the overall fund was, I don't know, up 20%, right? But when you look at the individual holding for that individual, right, and take account all the other costs and the transactions and the trades and everything else, right, quite often the real true return to that particular investor in the fund is nowhere near close to what that top level number was.
And particularly for small investors. So it's so what's happened is the super funds have decided, it's sort of the industry standard has become that to report performance is the performance of the fund at a gross level minus any investment fees. But they don't take away the administration fees, because the administration fees quite often have this fixed component to them. So there's a fixed part and a variable part. So somebody who's got $100,000 in the fund gets a different performance to somebody who's got $200,000 or $50,000 and all that type of stuff. So it sounds very reasonable that, okay, well, let's show it before the administration fees, and then people can work out the rest themselves. The problem is now, because that's the way, whenever these things happen, that's you push incentives that way, that then people change what they're doing. So now what you've seen over the last few years is investment fees have been coming down quite dramatically at all these super funds, but the admin fees have been going up on the other side, and so your net fee is about the same. But if you want to report your profitability, if you're a super fund that wants to report how well they're doing, then your numbers look better because your investment fees are lower, but your actual fees are roughly the same. So.
And that means that the APRA figures that are being sort of rolled out and quoted, right, are a particular lens, right? But it's not necessarily the only lens you should apply when you're thinking about what performance really was.
Absolutely. And the other really important point with all these is if you're looking at returns, especially now, you see all these funds that are going on. Look at how well we did over 12 months. A lot of these are the highest risk funds out there, and so they fell 30%, and then they rose 30% or 40% or whatever it is over the, you're not seeing the initial fall anymore, because that was more than a year ago. You're actually just seeing this rise, and so it sounds great to say, oh look, all these funds doing 15-20% per annum, but you're like, yes, but if you measure back to the start of the year, they've all done like 3 or 4%, and so it's important to say you want to make sure you haven't got that low base effect. That same thing we're talking about with inflation.
Base effects. You
fall, and then it just looks great from the bounce off the bottom.
Absolutely, yeah. So again, I think that the message is treat all of these performance statistics with a degree of caution. Ask them hard questions and drill down, because the actual real numbers could be quite different. Let's go on to another topic. This is one from Justin a little while ago, which was about, is land a good investment or just good for a first home buyer at its high price at the moment? So the interesting question about land, we know that there's a lot of property development companies, land banking in Australia. In other words, they bought land years ago and are sitting on it, right? And they're sitting on it watching the price go up and up and up and up and up, and eventually they might actually do something with it, right? I guess the question is that something which is applicable more broadly, or is it really just for the specialist land bankers?
Oh, yeah. Look, there's lots of things going on with that. Probably the biggest thing I'd say is, the biggest thing, if that's your plan, is to look out for the new stamp duty. Well, sorry, it's not a stamp duty, is it? The value uplift taxes they're putting on. So they're basically saying if you're basically buying on the outskirts in, say, a rural property, and then you're betting that that's going to get reclassified to urban, and all of a sudden you can build much more houses on it, that value uplift used to be a free kick for everyone. You bought a rural property that was worth whatever 500,000, and then next day at the sign of a pen it gets reclassified to urban, or you're buying property that you can build houses on, and all of a sudden you can build apartments on, and it goes from being worth 500,000 to being worth 5 million overnight. Is that now that uplift from the 500,000 to 5 million is going to be taxed? So there's less in a lot of, well, it's in Victoria it's happened, in New South Wales they're certainly looking at it. I think have they confirmed that, Martin, that they're going ahead with it in New South Wales?
It's certainly still in the works, but that they are offering the option, and they're going to roll it out more broadly, I think. Yeah, and
then so and it sounds like an idea of something could easily take on and sort of end up in a lot of places. So that sort of reduces some of the risk, some of the upside you might have seen in the past. And the other interesting one for land, for me, is solar power is coming down at this dramatic rate, and batteries are as well. And one of the big problems with rural properties, especially a lot of rural ones where in sort of more remote areas, is getting electricity and other services put on can be very, very expensive. But solar panels and batteries are actually starting to reduce that cost significantly, and so maybe that means it does open up a bit more supply. So that's your main risk, is you're basically betting on, will Australia keep trying to constrain the land, or will they actually open up and sort of let more supply in at some stage? So and land, obviously you have holding costs. There's a holding cost you have that you without anything to offset it. So it's I much prefer to see investments where you can say, well, even if I hold on to it, if you buy a house that's expensive but you can rent it out, and you're like, well, even if I hold on to it, at least I've got this cash flow coming in, and that'll help sort of defray the costs. Whereas land, that's just not the case.
Absolutely, and it is interesting because if you talk to some people in the real estate sector, they'll say the land is actually where the value is. You might have a house on it, but you could easily knock the house down and put something else on it, whatever. But it is the land, and it's the land that ultimately seems to be quite sticky. And then, of course, you've got this debate between those who say, well, we don't have enough supply of land, and therefore supply is the problem. And if you release more land, that would solve the housing problem, right? And you've got the other people, I'm in the other camp, that says, no, it's not about really the price of the land. It's about the availability of credit, because the more that credit is available, the more that it pumps up prices, and it pumps up the price of everything, including land. So it's very interesting to debate.
Yeah. And I'll add one more dimension to that as well, is it's this affordability part, and I'll plug our own property calculator as well, where we look at this affordability and the rent, how much it costs to rent. And I think there's a level where, if I said to you, Martin, would you like a nice beach house for $10,000? You'd go, oh, well, yeah, maybe we'll have a beach house if it's only $10,000, and you can live in your current house, and maybe you could have a house down at the ski slopes for the same price as well. And so people do have a desire to have more than one property and form bigger, and so there's a certain element of saying, if prices, as you said, the prices it's a relationship to credit, and it's the household formation part about saying, if prices are too low and people are making all this money and don't have any disincentive to buy more than one house, then history shows that's what they'll do. And then there's such a large amount of people that can get an extra flatmate or stay living with their parents for a little bit longer. That household formation can really drive that demand up or down quite significantly. And so, that whole affordability measure, which all comes back to those interest rates in the end, is pretty key.
Yeah, and then the other question is, migration directly or indirectly, right? Because migration is the other lever, right? And if you think about there are two things that actually create the contention. One is low interest rates, big loans, loose lending standards, right? And then more people demanding property and therefore coming in, particularly from overseas and buying. So if you have very strong migration, then the population growth is quite strong, whereas at the moment the population growth is pretty weak. And we also know we've got, 1.2 million spare properties across Australia. So, the old supply, I call it the supply lie, right? There isn't really an undersupply of property. It's just and there's an undersupply maybe of affordable property, but the real estate sector and the construction sector continue to spruik the continued construction because that's what they do.
Yeah, look, I've got, and that's right. I have more sympathy for the construction sector than I do for the selling, because at least you go, well, okay, you're out building new properties and hopefully contributing, to it versus just selling, versus the two of us, Martin, buying and selling houses between each other and bidding the price up every time. And, I bought it for 500,000 and then you buy it back for 600, then I buy it back from you for 700. We just keep bidding the price up. We're like, it's still the same house. Nothing's happened to it. At least with the construction side, you're like, well, we built some new amenities, and it means we can, people can have bigger houses, or we can have more households, or people can be happier, hopefully. But yeah.
Yeah, very interesting. And with all of these things, it's never one thing, right? There's always it's a multifactorial, right? And that's why you find that regulators and central banks and other people just say, no, it's not negative, it's somebody else's problem, right? I think there's an interesting debate at the moment is, do we need a Royal Commission on Housing, right? Would that be helpful, right? And there are some cynics around to say, well, Royal Commission on Banking didn't actually serve us that well, so why would a Royal Commission on Housing do anything more, bearing in mind, of course, the fact that there is so much. But the federal government has announced a political inquiry into the supply side of housing, right? So it's sort of a small carved out piece of the puzzle, as though that's the piece that's going to solve the problem. And I think, no. if you're going to do it, you've got to have some joined up thinking here and actually understand how holistically it all hangs together. And there was a report done quite recently called "Housing: Taming the Elephant in the Economy," right? Arguing that actually, if you look at it holistically, with all the construction, all the finance, and everything else, what's happening with the housing sector is really trampling the rest of the economy. It's sucking the air out, and basically they argued for a holistic requirement to think about this. So they actually said, well, we need a Royal Commission. I'm not sure whether it would actually get much heat. It may get heat probably, but much light out at the end of it.
Yeah, I don't know. It's like a good therapeutic scream into your pillow, Martin. That doesn't help anything, but maybe it makes you feel better for a little bit. It hasn't solved the whatever problem it was. It was.
And that's the point I made on Twitter today. If there had been an intent to solve this, it could have been solved years ago, right? There is no political intent to solve this. That's the point. Because it's the election cycle, the political cycle, it's the wealth effect, it's the winning the next election stuff, which is much more important than actually fundamentally solving housing affordability or anything else like that, right? That's the problem we've actually got. So there's a mixed message and mixed agenda going on.
Yeah, and I think, it's hard to say, because obviously government-built housing tends to be the worst. Tends to certainly look the worst housing 20 years later, but it does seem as if there's a decent correlation between when economies that used to in the 60s and 70s have quite a large sort of government-funded building of houses, and particularly the lower value types of houses, because if you're a developer, you don't want to build those houses because you don't get as good a profit margin in it, and affordability, and so I think there's. Look, it's a good thing to have a Royal Commission. I don't want to, it would be good to look more into the housing and a holistic picture, but even looking at any component of it would be good. Let's just hope though that the Royal Banking Commission came out with a list of recommendations that on day one we were going to put them all in, and by day 60 it was like, well, maybe we won't put any of them in.
Yes.
And maybe the very first one will actually go completely the opposite direction to what they said. Yeah. So, just I'll put that in context for people who probably aren't as close. As the very first one was, we've already got the laws. We don't, we've already got these responsible lending laws. We don't need to change them. And now we're trying to change them. We're trying to make them easier. And so, So,
and that was the definitive recommendation from the Royal Commission: keep those responsible lending laws, right? And yet they were the ones that were trying to be removed. They've sort of got stuck in Parliament at the moment, so they're still with us at the moment. And it's interesting that if you go back to the financial service inquiry that David Murray actually oversaw, he made a very important recommendation that he regarded the need for a super regulation. In other words, a regulator looking down as to what the RBA, APRA and ASIC were actually doing, right, to make them accountable, right? And guess what? That was the one that was thrown out immediately.
Yeah. I think as well. A big picture sort of look at what's happened is we've had these, and certainly I'm looking for my industry in terms of financial planning and the issues that you had in terms of that vertical integration, is that there was a bunch of rules put in sort of 10 years ago, and I think they were largely skirted around, and that's the main problem that, the people who ran into trouble like AMP and IWF and a few others, was that they're like, well, whatever you're doing is designed to sort of, so that you don't have to do what the rules told you're meant to do. And then that was sort of the real push behind, which is why I said, a lot of these responsible lending laws and other things was like, it was a lot of it was about saying you just need to apply the rules you have at the moment and not let people cheat them. And and so I think that's where I think in the housing side, it would be good to shine a light on those parts to actually come back to things that we know what most of the answers are, and they've come out. There's things, whether it be broad-based land taxes, and so you actually create a cost for make it easier for people to move, and you don't sort of tell people that if you want to change jobs between one side of Sydney to the other, you're going to have to spend 10 years worth of savings to do it in order to move and pay these stamp duties. And you try and make it incentivize people somebody who's husband's passed on and all their kids have moved out, you want to encourage them from moving out of a 5-bedroom house in the suburbs into something smaller, whereas the current system discourages it. And so there's all these things that would I'm assuming a Royal Commission would actually show up and point them out, but we know they're all there, and they've come out in any number of different surveys. But it'd be nice to remind it again of them, and maybe one or two of them might get picked up on, and hopefully we'll chip away, and eventually, I don't know, maybe I'm being too optimistic now. Maybe we'll eventually end up with a working system, but now I'm just talking crazy.
Well, good to be optimistic. That's what I think. Here's one from Evan, which I think is quite interesting. How do you think the government will approach wage growth with a drop in immigration starting to push up wages? I heard the recent labour shortage is starting to blow up the RBA models. It's a very interesting question, right, about wages growth, because the Reserve Bank is saying, there'll be some wages growth, but it'll be very slow over the next 2 or 3 years. And then Philip Lowe said, and in fact, if you allow immigration to start again, that's going to put more downward pressure on wages.
Yeah, so these are the old wage growth models that they kept getting wrong, or the new ones that they've built since then?
Good question. Have they got some new ones now?
I'm hoping so. I think to their credit is, there's not too many people who would have put out that chart saying, hey, look, we've been forecasting prop wage growth wrong for like 10 years.
Yeah.
And there's a famous chart out there for anyone who hasn't seen it that's sort of basically showing that every year the RBA was forecasting wages would go back to trend, and every year they didn't. And now they've sort of come out and said, look, we think a lot of that, well, they've come out at least acknowledging that's a problem, and they said we actually need to see this wage growth and get it back. And recently they've come out saying that, okay, maybe all that immigration that we've been running, maybe that was actually was helping to cause some of the low wage growth. So I think absolutely that immigration does contribute to low wage growth. I think there's a bunch of different skilled wages sectors that just aren't skilled wages sectors. I think there's, if you look at the sort of, in theory, if you're trying to bring in, if you've got genuine skills shortages, then, and you're bringing in these skilled migrants to fill those, then theoretically the wages of those migrants should actually be higher than the people working in your economy, because we haven't got people to do this job. We need to bring in specialists from overseas to do it. Wouldn't you think you'd actually need to pay these people more to bring them in? But that's not the case. It's actually the opposite. And so I think there's a very strong case to show that. To show that immigration is at the heart of some of the low wage problems. Having said that, though, I don't think it's the whole story. I think there are also deflationary issues. I think there's been a huge loss of bargaining power from employees. Just the rate of unionisation's gone down. Now with work from home being significantly more than what it was 2 years ago, a lot of developed countries around the world have opened themselves up now to competition for job roles from emerging markets that can pay much lower salaries. So I do think there's a lot of other things. There's a lot of other factors. I'm relatively hopeful we'll see a bit of wage growth. I don't think it'll get out of control. And I do think there are some quite significant pressures that could come back down to bear, especially if we did reopen the immigration, that could see wage growth, any sort of positive movement on the wage growth sort of wiped out. So I'm hopeful, but I'm certainly not expecting wage growth to get out of control. And I'm worried that we'll go back to what we used to do, and that'll see wage growth shrink.
Yes, well, there's certainly a lot of people in Australia in my surveys who have seen no wages growth for a long, long time. Cost of living going up, wages growth flat, hours going down rather than up. That's why we've got a bit of a crunch at the moment in terms of many households.
Yeah, and the other thing to remember as well is we've had a fair bit of structural change as well. So, if manufacturing that's suddenly taken off, or more home building, and they need to get more people to come and work there, and they need to convince, whatever it is, somebody who is a laid off airline host or hostess to come and pick up pick up some tools and help with the building, or sit on, or come work for a construction company and sit behind a desk or whatever it is. So there's a certain element of, you need to offer some higher wages to entice the people to stop waiting for their old job to come back and come work in a new sector. But that's by its very nature, relatively transitory, and it could flip back the other direction as well. Once the reopening happens, is that you'll go back to more people working in entertainment and fewer people working in some of these other some of the other newer sectors.
Absolutely right. Yeah, well, I think there's a lot to play in there, and you can overlay education, you can overlay skills and investment in skills, all of those things, which another area which I'm get frustrated about, because we're not focusing enough on building the labour force we need for the next generation. Frankly, it's that's the real question for me.
And that's exactly, and that's for me as well. Yeah, from an investment perspective, you look at these and go, that's great. If you can bring in lots of people, you keep your costs down, and your companies get all the profits. So from an investment perspective, it works out that way. From a social engineering perspective, though, I'd much prefer to see that more wages are being earned, and you'll get more. You get a more sustainable long-term growth if you actually got wage growth and growing, and the benefits being shared more equally. That'll lead to sustainable growth, and it would be great to be able to see companies, rather than say we've got a skills shortage. We need to bring people in from overseas and say we've got a skills shortage. Why don't we train a few Australians to do this role?
Yeah, but you see, that's really the big question, isn't it? Which is, what is society for, right? Because it seems to me it should be more than just turning a dollar, and making shareholders richer, right? There's a bunch of other important values that should be as part of the story too.
Yeah, absolutely. And so, and I don't want to. I guess I don't want to try and tell people that let's say within our fund is a good way of how examples how we'll invest on this basis is we'll look upon these things and say, okay, this is not a good trend for society, but it's not looking like changing, and so we're going to invest in the companies that will benefit from that. We have some ethical screens you can put on over the top with a view that some people don't want to invest in those companies, and they can just wipe those out, and so they don't. We just reduce the stocks. So rather than getting a 95 stock portfolio, you might only get a 90 stock portfolio, because you don't want any tobacco stocks and gaming stocks in your portfolio or things like that. And so, I think from an investing point of view, very much, people should be aware that, or at least keep in mind that you have options to say you don't have to invest in stuff you don't like. And so, and life is more than just about money. So, but it's a grey area. Everyone's got a different view. And so we try and invest based on what we think will make money, but we're certainly happy enough to call out that behaviour when we see it, and also give investors the option to wipe those stocks out of their portfolio so that they don't benefit from it.
All right, we're running up against our deadline, but there were two questions which I just wanted to touch on. I had quite a few people ask about precious metals, and particularly gold, silver. What's your view of those? And it comes back to a fundamental question for me is, where is the value anchor point, right? Is the value anchor point the dollar? Is it gold? Is it the US dollar? Or is it crypto? That seems to me to be the really interesting question.
Gold's a currency. It's gold's lots of things, but I think the most important thing is to treat it as a currency.
Yeah.
In terms of an investment sense. And so, if everyone's trying to devalue their currencies, then there's some benefit in gold, and everyone is trying to devalue their currencies. But then there are some other issues in terms of, a little bit in terms of supply, but mainly on that front is that basically if central banks decide or investors decided to sell, then that would wipe out the entire market. So it's to a certain extent, well, to a large extent, it's basically it's the, can I do something before other investors do it? And so, so you need to be aware of what's happening within that market and what are the trends, and are you facing these issues with inflation or not? And at the moment, we're not really facing those issues with inflation. We have central banks trying to get out there and print money and devalue currencies, but but it's really not working that well. And so, when the days when we wake up and everyone is worried again that the inflation is about to take off, there's certainly some value in looking at those and looking at, but I would treat them as a small part of a portfolio rather than as needing to be like a major part of what you have.
This is interesting because I speak to some people who have a lot of their wealth tied up in metals as though that's the only thing that's got value. It's the only value hook they can see, right? So whatever else is going on out there, at least I know I've got my gold. And then I say, well, just look at the price of gold, right? It's dropped below 1800 again now, US, right? Hasn't done a huge amount over recent times. May later, but what is its purpose?
Yeah, well, there's some fantastic industrial purposes. If it was priced that's sort of more similar to sort of copper or something like that, there'd be thousands of extremely valuable uses you could put gold to. But it is it's worth what the next person's willing to pay for it. Really, is the industrial use of it is so small relative to investors and central banks. So it's a greater full investment, as they call it. I just need somebody else to buy it for me at a higher price, which is very similar to, which is why when people call digital, bitcoins and everything like that, the digital gold, there's a certain truth to that. I just need somebody else to pay more for this, and that goes to trading cards or Beanie Babies or whatever it is that you think someone is going to pay more for. But that's different to investing.
And interestingly, both gold and silver and cryptos have a whole derivatives framework around them, right? And so one of the things that I keep coming back to and I keep highlighting to people is you can't think of these as pure markets, right? Because there are people basically taking positions using derivatives to be able to actually influence what's happening beyond your ken in terms of looking at the price at any point in time. Yeah.
So some of that for gold is producers who are trying to hedge their production. They want to make sure, if it's costing them $1,500 an ounce and to produce it, and the prices are $1,800, and they're like, well, I want to make sure I make, I'll at least can pay the bills if it all turns. There's a bit of hedging within that, but then, as you said, a lot of it's just speculation, which is others sort of trying to push things in different directions.
And getting on the Twitter and getting on the Reddit and trying to persuade people to buy or sell or whatever, but don't get me started on that.
but that's exactly the greater fool thing. If I can get onto a platform and find more fools, then I've found my greater fools. So
correct. Yeah. Welcome to the realities of the market. Okay, last question. Well, probably last question for tonight. And I know that you're not going to take a political stance on this, but Labour has now retreated on capital gains tax and negative gearing changes, right? So basically there's no light now between the two parties on that very important policy platform. No surprise from me. I expected it to happen because I didn't think they were going to try and stand out as a big target. But what that basically says is that both sides of politics have the same lens through which they look at property and capital gains, which is an interesting observation for Australia, isn't it?
Yeah. So can you tell me what the Labor what Labor differences are to the Liberal Party? What are the major policy places?
I don't know, not on those two, because basically they said, well, we'll let the capital gains taxes and negative gearing changes stay rather than
and we're going to push through the wage cuts the tax cuts for high wage earners.
Correct, exactly right. So they're basically following ScoMo's policy settings, right, on those particular things. So there's no light between the two. So small target, right?
Yeah.
Interesting.
Yeah, that's right. Well, it's the same target in a way. It's just basically we're the same as those guys, except we promise not to rape as many people, or I don't know, or cover up as many. I don't know. I guess what I'm saying is I don't think there's a lot of choice between either party at the moment.
No,
I think there's
that's my point. That's my exact point. Yeah.
But from an investment point of view, okay. So let's not get political. Because, there's people agree with some and the others. Well, I won't go there. Yeah. From an investment point of view, it actually means there's a fair bit of certainty around at the moment.
Yes.
There's neither on the looking for something different. There's chances are if somebody does come up with a policy and the other one will probably come up with something very, very similar to it. So from an investment point of view, there doesn't look to be a lot of change, which is which is good because there's so much other change going on elsewhere. But from a bigger picture sort of society point of view the other thing that's good is companies have been one of the big winners from this whole process. So corporate profitability is great at the moment. And we've got this reporting season going on in the US and it's still going great. It's upgrades all around. So whether that's a great outcome for society, again, I'll leave that to the side. But as an investor, when you go, well, both sides are committed to letting companies be as profitable as they can and trying to funnel as much towards them as they can, then it's hard to take the other side of that bet purely from a moral perspective of, So I think maybe vote for people who might help deliver that outcome. But at the moment, it's invest like this is the world we live in, and and until we see significant change, this is where we are.
Very last question for tonight from Cookie. Tomorrow's inflation number will be, Shane Oliver is saying 3%, highest 3.9%. It's going to be quite strong, isn't it?
Yeah, it will. Look, it's going to be strong. It's going to be above the RBA's band. The tough thing is Australia reports its inflation so infrequently that you sort of lose track. In a way, I lose track because I'm looking at so many other countries and what's happening with inflation and trying to work out. So they're mainly looking like they're peaking and starting to come back. So I'm not going to have a look. I don't take a guess at it. I think it will be. To be honest, I'm probably less concerned as well about what's happening with Australian inflation because we are so open to the rest of the world. I'm more concerned about what's happening to world inflation. Yeah. And that does seem to be peaking and coming back. And the problem with Australian inflation is, here we are almost at the end of July. We're about to tell us what was inflation for the 3-month period in which we know it was really strong in March and April, and then starting to taper off by the time April and May, and starting to taper off by the time we got to June. But we're not going to find out for another 3 months what's actually going on right now. And so, I think unfortunately, the Australian inflation read is relatively useless from an investment perspective.
It's pretty meaningless, isn't it? Although, of course, it'll be all over the headlines and there'll be massive amounts of mainstream media coverage. But
and there'll be people
signifying
saying,
not a lot.
Yeah, and there'll be people saying, hey, we have to raise rates, look at the inflation. That's exactly what we saw in the US. Yeah. So the thing to keep in mind is, and this is we spoke about this definitely last month, and I'm sure the month before as well, is that there's a lot of people out there who have been saying inflation is coming for 10 years or more. Since the financial crisis, they were like, all this government money printing is going to cause runaway inflation. It's going to be terrible. There's going to be hyperinflation. It's the end of the world as you know it. And they've had 10 years of not actually having that come true. Tomorrow is going to be one of the few times where they'll be able to stand and say, look, inflation's here. It's a time to be, you got to pull your head in. You got to stop spending all this money. You got to do all these other things, And so, and as I said, they're going to get their moment in the sunshine. And so maybe markets will react to it. I think, I expect they won't, because I think they're more focused on looking at other countries where you get a much more an ongoing read in inflation. So looking very much to say China's struggling with inflation is low. US is got some very high inflation, but when you look at the components, it does very much seem to be in the transitory elements of it. So I think that's the key place to watch.
And that'll be the debate, won't it? Transitory or not. The risk of policy misstep, of course, if it's a really big number and there's a lot of pressure from the markets and elsewhere for rates to move up, they might move them up perhaps too soon. On the other hand, we know that CPI is not necessarily a very good reflection of real experiences of real people. So there's a bunch of complexes.
Yeah. Well, and the other thing is Sydney and Melbourne have gone into lockdown since then. Well, Melbourne's hopefully out as of another 2.5 hours. But they're not going to. I find it highly unlikely that on a backward-looking measure like that the RBA would really be doing anything. I don't think they would. They'd look at the number of things that have changed and almost just go, well, it's meaningless. it's meaningless as a number, regardless of how high or low it comes in. What we really need to be looking at is what's going to be the effect of these Sydney lockdowns and changes in demand and other things like that are going on right now.
So I've got this here. They've got these series of @rands inside the Excel spreadsheet, right? They push the button and out comes a number. It could be no better, no worse. Look, we've run out of time. I've got loads of questions we didn't get to, but Damien, I want to say thank you very much for your time tonight. Just to say, as I always do, if you want to find more about what the world funds and nucleus wealth, go to whattheworld.com.au. There's a whole lot of information there. I think this association works really well in terms of actually sharing some thoughts. So,
and register your email address. We'll send you out, information. Not only just there might be a little bit of sales stuff, but research information as well. We'll send you out, the latest, what our thoughts are on these, and so you get to keep up to date with what's going on and how our thinking's evolving.
Terrific, and hopefully we'll do it again at the end of next month. Seems to be a good time of the the sequence to do it, which I think is around the 30th. So if you're up for that, then that will be terrific. And
sounds good. Hoping you guys will be. So is that after your lockdown?
No, I suspect we'll still be locked down. Unfortunately, I think this is going to be a long, slow grind because we still haven't hit the peak yet, unfortunately. So, anyway. But enjoy your freedoms. I guess it's timely that because you've had more time locked down than we have so far. But
that's right. You've got a while to go before you catch up. Yeah, best of luck for everyone out there who is in lockdown and for those who aren't, get yourself vaccinated, and let's hopefully we'll come out the other side of this.
Absolutely. Well, thank you very much for your time tonight. Really appreciate it. I'm going to take you offline now, and I'll just close out the show. So hopefully that worked. Yes, it did. Good. And just to let you know that next week you will have the pleasure of myself. And I'll be entertaining you talking about the household stress and scenario updates. A lot of information, a lot of new data because, of course, what's happening with all the lockdowns. So it'll be worth joining me for that at 8 p.m. The next Tuesday. So look out for that. Damien, thank you very much for your time tonight. Really enjoyed having you on. Thanks very much for watching. And take care, everybody. And we'll see you next time. This is Martin North from Digital Finance Analytics, signing off. Good night.